Good evening, everyone. Nice to see you again. So that's the fourth session on the portfolio management during crisis. I wanted at the start of March to try to help you and doing those sessions and trying to cover the different asset classes. For those of you who don't know me, I've been trading for the last 20 years as both a hedge fund manager and a prop trader. And I've been mentoring people as well since 2014. So today what we're going to cover as usual, we're going to start with the situation across asset classes. We're going to be looking at the S&P 500. We're going to be looking at WTI, a bit of credit, a bit of FX, and a bit of gold as well. Then something that we discussed at any session is the role of the central banks. So we're going to be discussing what the Fed has been doing, and today they went with a big bazooka. We're going to be discussing the oil market, then earnings season, implied volatility versus realized volatility. Then it's going to be opening the floor to Q&A sessions. So in terms of the next few days, we have a long weekend because it's Easter. So the market in Europe and in the US is going to be closed tomorrow. It's opening back on Monday in the US. And if you look at what happened today, is you had a lot of deals happening at the same time, and all those deals obviously happened just before the US closed. So we got the Eurogroup announcement, or almost, and we had the WTI or the oil announcement with the OPEC, non-OPEC. And that's always the same. You do have like all these agreements that come just before those long weekends, okay? And this is the magic of those markets, especially these days. And what we had since last week, last Thursday, is we had a risk on across asset classes. Okay, we discussed many times the role of the central banks and how they have been pushing hard to help the economies, which is a great thing because this is their role. And if we look at the chart of the S&P, the lows were done on the 23rd of March, which was exactly the day where the Fed announced infinite QE or infinity QE. So last week, when we look at the chart, and maybe we can start from here, looking at the chart of the S&P, when we look at an hourly basis, we look at this resistance at 26.35, roughly. So we had first a bounce and coming, and then we broke this level. And then, as I told you last week, there was not much between 26.30 and 27.40. So we literally went 100 points. Then we came back. We used now the past resistance as a support. Then we came. And then now we went to the next resistance, which is 2800, 2850. So the part of the game is, if you want to be long and short, is obviously what you want to be short. You can look smart and say 2800, 2900, 3000, and every 50 points. So you need to have some kind of conviction on the levels. So as you can see on that chart, this level is 2800. So this is where we are. Between 2800 and 2950, there is not much. Okay, so if we go 2950 is the last big resistance. Otherwise, we go all the way to the sky. But as I said, the 23rd, that is the bottom of the S&P when we had the Fed. I think what is important for you is having, for any of us, is trying to have some levels where we start to have net exposure. And you don't have to be big in terms of net exposure. It has to be small. So to give you an indication, I started to build a short position, and maybe it's going to be in my face because very often when I go for the future, it goes in against me. But around 27.50, 27.40, I sold 10 to 15% net short position, and now at the moment at between 15 and 20%, and that's through ETF. Okay, so I haven't done any futures, any options, because options at this price, I mean, it's a bit of a struggle. So we'll have a look later. But so that's for the S&P. This is the price action. Price action has been very strong. And what has been interesting today is the XLF sector with the financial, which has been extremely, extremely strong. So far, it was pretty weak. So as you see here, so if we do the XLF on a standalone basis, today was a strong day, and I would love to do it on a daily basis instead of Okay, so you see the gap, it's coming back into a support level. Why? Because the decision made by the Fed today is going to help the sector massively. And plus, as we're going to see later during the slides, is earnings season is going to kick off on Tuesday with JP Morgan and some other names. So let's carry on with the other asset classes. So again, you need, one of the struggles of many of my mentees, they come to me and say, look, I don't know where to look at because I'm confused. There are so much information, there are so much moves. The thing is, you need to be looking at the different asset classes and thinking, okay, what is going to make them move and what is moving and what is the price action telling us? If we think about the S&P, if we think about stocks, you know, at the end of the day, they are still a second derivative of the credit market. So what happened is the credit market went into a lot of pressure. This is something that we covered many, many times. So that's the LQD. And you remember that was 2 weeks ago, the Fed said, we're going to buy ETF for those corporate bonds. And we are back to the all-time high almost. And today, they did the same with another ETF that we're going to discover during this call. But that's the credit. The credit is in a better shape than it was a couple of weeks ago, or even 10 days ago. So that's helping all the asset classes and the risk on asset across asset classes. If so, we get some question from Nicholas, for instance, on WTI. So that's something we're going to cover later. But as you can see, the price action for WTI has been extremely weak. And as we discussed, because this is the issue is on the demand side. So if roughly you take 100 million barrels as the daily production, and versus that you get the demand. The demand is roughly down 20 to 30% since we had the lockdown. 20 to 30% gives you 20 to 30 million barrels. So even if the OPEC and non-OPEC are cutting by 15 million, okay, so 10 millions today with OPEC and another 5 million with non-OPEC or the US, you still get an imbalance of 5 to 10 millions for at least a couple of months. Okay, so that means this imbalance. Then you need to swallow this imbalance after this next 2 to 3 months. So this is why you have WTI that is in low 20s. As they said today during the meeting, if they didn't reach a deal, we were going straight into the 10s and probably the low 10s. That tells you about the scale of the slowdown. I mean, you don't need to be extremely smart to know how the whole world is stopping at the moment. Okay, so that's for WTI. On the gold, let's look at the future. So that has been the move. I look at it. I'm not very good at trading the gold. Okay, so I have to be honest. This is not my core business because I always think that there is much more to do with stocks. But you can't deny that gold is close to making new highs or going for this 1800. I think from my reading, and again, I'm not a specialist, is there was a massive imbalance between the futures and the cash. So the cash, the physical, there was a struggle for people to get physical gold. And actually, even when it was trading at 1600 on the future, the cash, the physical was trading 1800, 1900. So they changed some of the contract as we discussed last week on the futures, but still there is an imbalance. There is good chance that we're going to go for 1800, plus the infinity QE is not helping the confidence of people. So you do have like many, not many, but you do have like decent money allocation that goes into the gold. So talking about now into the currencies, euro dollar, at the start of this week, I don't know if you saw that, I tweeted on the Mexican peso, which was trading at 25, and I thought the risk reward was good. Why? Because it was a risk on, risk off. Mexican peso suffered massively. So those are the trades that you should be looking at, where your downside was at 25, something like 25.75, which was 3% below or above. And actually for retracement, you could be making decent money. But the bottom line of all the currencies is the Fed has been extremely powerful and extremely relevant at mitigating the impact of a strong dollar by doing this FX dollar swaps. So something again that we discussed. The Fed injected a lot of money or made available a lot of dollar to the central banks around the world, and that helped the euro dollar and other currencies for the dollar strength to be not as strong as before. What we're going to be facing is in the next 18 months is the second wave of a strong dollar. So if you remember in 2018 with the Turkish lira, the ZAR, we know that many emerging markets and many countries have been printing bonds in dollar. Okay, and that means it's fine as long as your economy is doing fine and as long as your currency is not weakening versus the dollar. So now those countries need to pay back those bonds in dollar, and there is a shortage of dollar. So we could see really big pressure in the next 18 months on emerging market. So that's something to check the imbalance, which country is printing, because at the moment we are just, in sell-off, risk on, risk off, and people are not really thinking. I think emerging market, if it stays here for too long, first because the world is slowing, meaning emerging markets is going to suffer big time, and secondly because of this imbalance and the size of the bonds that they printed over the last 10 years, that could be a big issue. Okay, so we've done here the currency very quickly. Then, as usual, what I strongly advise you to do, and I've done some blogs and put in some numbers, and if you want the Excel spreadsheet, you can have it, is doing some drilling through the sectors level. So this is something I'm really pushing for all my mentees to be building, is the sector level. Which sector is underperforming or outperforming the overall market? Why? Because it's telling you about the market appetite overall. And then, if you go into the next level, you can go from the sector level into the industry level. So yes, Mark, yes, I agree with the Real. Clearly, Real has been doing the same move. All emerging markets are suffering. But I think it could be even worse. And I think it could be even worse, not even on a country level, but on the company's level. So you have many companies, local companies that have been emitting bonds in dollar. And now, so that means why you need to be looking at the balance sheet of all those companies, local companies, and see what kind of bonds they are holding. Because if your currency is down 20-30% year to date over 6 months, you're going to be suffering quite a lot. So again, price action, looking at where we are, S&P 2800, 2815 is a big level. Then you get 2950. Risk on, do you want to be fighting the Fed? That's the big questions. I think if you look at what happened over the last couple of weeks in terms of retail trading, many retail traders came into the market because when there is some noise, there is new players. And because you think that you do have like a lot of doom and gloom, and with little risk management, then they put their short position and now they need to cut. My philosophy, and that's the same with the 4x4 video series, is you don't want to do more than 30% net position, long or short, okay, especially these days. That means that if you're wrong, you're not going to be killing the whole performance of your whole book. So when looking at sectors performance, do you look at ETF indices or stock by stock? So that's from Nicholas. I always start from the top of the universe. So if you take the US, that will be the S&P 500. Then from the S&P 500, I will be taking the 11 sectors. And from these 11 sectors, I will be looking at these 75 to 80 industries. And then you will go into the single names. That's the price action. That gives you the reversion to the mean. That gives you which industries are doing well. That tells you a lot about the underlying market. Okay, so let's go back into the sheet here. So today we get the Fed announcement. So you remember on the 23rd, this massive QE infinity, where the balance sheet went from 4.2 trillion to, I think at yesterday, something like 5.8 trillion. Theodore, I'll ask me this question at the end. I think I'm moving now to the Fed announcement, but I'm happy to answer your question later. So Fed announcement that was done today. I don't know, for maybe some of you listened to Mr. Powell during this Zoom Unreal video conference. I mean, it's fine when it's with me and I'm sitting with my kids above, but when that's the Fed chairman Powell, that is a bit weird. But he was saying that's the 9th different facilities, and every day almost you get a new announcement coming from the Fed. So I told you 2 or 3 weeks ago what you should be doing is putting your name or your address email into the Fed or the New York Fed website to get all this information. That is helpful because you're gonna have the information live. So today they announced 2.3 trillion loans to support the economy. And they said, and let me quote them, the facility will purchase up to 500 billion of short-term notes directly from the US states. So what does that mean? That means they're going to be buying 500 billions of municipalities. You remember a couple of weeks ago, we looked at municipalities and all these ETFs and names that were absolutely murdered. But what is interesting is they changed a bit the mandate, is they kind of went from the lower note on the quality of the bonds. So they used to be buying decent quality bonds, whereas now they are happy to be buying junk ETF. Okay, so this is for the next, that would be for the next slide. But one corporate credit backstop will be expanded to include so-called fallen angels that were investment grade in mid-March, but have subsequently been downgraded 1 notch from BBB to BB. So why is it important? Because many names have been downgraded already and went into a proper sell-off. And those are the names like Ford, for instance. And now the Fed is telling us we are happy to be buying those bonds. So on one hand, as we discussed before, I'm really happy to see the Fed doing its job, which is, you know, putting some money in the system and making sure that the pipes of lending and borrowing are completely fine. Okay, so this is repo, this is FX swaps. For QE, I'm always a bit struggling. So I understand that you want to mitigate the absolute crash that is the economy, and that is as well the role of the Fed. But here you are completely killing price discovery. And you're kind of saying, I'm taking the losses, hoping that I'm going to recover those losses in the future. And if you think about what the Fed has been doing when they try to reduce the size of the balance sheet, very quickly they realized that they were not in a position to reduce the size of this balance sheet. So my struggle is, if we are in a system where we need to price the risk of default, and we can't be pricing this price of default now because everything is at the same price, then you have a problem. And you don't have a problem right now because you're trying in a good way to help the whole economy. But that means in the long run, that doesn't work. And you have to do even more for the next time. So you do have like diminishing returns. So I'm not blaming the Fed because it is extremely hard to do. But in the meantime, I think it's too much and helping here right now is not helping. So we better off, you know, sometimes cleaning the system to a certain extent. The issue now is we can't be cleaning the system because the market is just plummeting. But that gives you the idea. So let's look at what the Fed did last week. So a couple of weeks ago. So this is the LQD. So this is investment grade. And as you can see, investment grade, I think now it's even higher. It's at 131 or 132 because that was yesterday. Went back to almost the all-time high. Why? Because the Fed now in its mandate had the authorization to be buying those bonds. So from the bottom, when it was announced from QE Infinity on the 23rd of March to yesterday, this ETF recorded 8.5 billion of new inflows. So we went from 31.5 billion 10 days ago to 40 billion. So the assets were up 30%. So that tells you about the whole risk on, which is credit. And again, for us, for everyone, we should be looking at how the credit has been doing and how the credit is still doing, because that's going to tell us about where to do a risk on, risk off. So LQD, those are the names that you can find. This is quite a very diversified ETF. So I strongly advise you how to do it. You go on Yahoo Finance, you go and you type LQD, and you're going to go on in holdings, and in holdings they're going to give you the names, and then you look at the names, how the names are going to be have been trading recently. So that's something that I've been doing for HYG. So today the Fed, with this 2.3 trillion announcement, said that they will be buying those fallen angels bonds. Okay, fallen angels more or less means now high yield bonds. So it's a bit of so you are going one notch down in terms of crappy crap. But today the ETF was up 6%. Okay, last week we looked at a similar ETF for Europeans for Europe that was exactly the same. But now the Fed is saying, I'm on the bid, I'm going to be buying those things. So similar, you can go onto Yahoo Finance and be looking at the names that are making up this HYG. So if you look at Altis, which is a French company, Sprint, and some others, then you can go into the FINRA website, which gives you some of the names and how the names have been doing. So this is for Ford, which was downgraded recently from to garbage, okay, to high yield. So the bond was trading 130 at the start of the sell-off, and it went to 80. So now the Fed will be in a position through its mandate to be buying those names. And that's going to help massively, obviously, the credit market and the risk on. Okay, so every week, look at the Fed announcement, trying to understand where they're going to buy and what are the repercussions that you're going to have across asset classes. Again, this is mostly about credit market. The equity market is a second derivative of the credit market, but the risk is on the credit. Okay, so let's jump now into the WTI. So WTI, so Nicolas, you asked some questions about WTI. Again, as I try to explain, always the same, you need to have some numbers to remember. Think about 100 million production, 100 million supply, 100 million production, 100 million demand. Demand is down 20 to 30%. So you do have like 20 to 30 million demand that is going through the window, and you need to find a new market to obviously either the price to go much lower or to cut the production. So this is why today we get the announcement of 10 million barrels cut. Plus, naturally, the US is cutting production because you do have like a lot of production that is going offline. So here we get the WTI contango backwardation. So those are the prices of the future contracts. Okay, so if we look at the contracts that we have here, so that's the cash that will be for the future contracts. As you can see, from July onwards, the prices are more or less the same. Okay, so this is the curve that you have here. But before that, you have like a massive steepening. And this steepening goes until the end of June. So the market, the WTI market is telling you before the beginning of July, there's going to be a massive imbalance. So if we are start of April, that gives you another 3 months. Okay, so you get 3 months of very low demand. So we should expect, the market is pricing right now lockdown across the world for the next 3 months. Okay, so that's where we can find this data online. You go on investing.com, you type CL, and then you get all the contracts. I mean, CZ, or you go on the cboe.com and you're gonna have, you don't even have to pay for anything. You just need to do, here I've done a bit of easy coding just to collect the data, but you could do the same. So WTI, why I spend so much time on WTI? Because as I told you before, I think this is really the not the leading indicator, but a good indicator to tell you how the economies have been doing. Okay, we know that the economies are really, really bad. But here, what is priced? Okay, what is priced in the next 2 to 3 months? The next 2 to 3 months, we should not expect the economy to be bouncing. So if actually we are in lockdown in not as long as the end of June, that could be a positive. Okay, so WTI, we've done it. When we have a portfolio management, when we're trading our money, when you're working as a professional, you are the supply and demand data for oil barrels have, so that's for a question for Alec. Where do you find the supply and demand data for oil barrels? If you go on my website, I've done a blog in 2008, at the end of 2018, where I explain where oil and how to get the data. It's pretty easy as well. You get the IEA, which is providing all the data. Everything you can find it online. You don't need to pay. Again, historically, the demand is up 1% normally. This year, it's going to be down 20%. And the supply, it's OPEC and non-OPEC. And with the idea that the US have been, let's say 5-10 years ago, they used to be importing oil. Now they are exporting oil. But you need to understand as well, where is the break-even for the industry? So the industry has a break-even between 45, 55, maybe it's changing a bit to low 40s now. But if you are below 40, that means many players need to cut the production. If you are in the US and you can you can drill and going for a new project, you can launch a new product. From the moment you launch a new project to the moment you're drilling oil, it might take 1 to 2 months. If you are a big major like Total, like Royal Dutch, from the moment you decide to go for an investment, from the moment you start to drill the oil, it's going to take you 12 to 18 months. So that means when you turn off the oil, you really need to think twice to make sure that oil is going to stay low, because otherwise to restart the engine is going to take a lot of time. Okay, so we've done WTI, and as I said, what you want to be having as when you're trading, when you're having a portfolio, is what's going to happen next. Okay, so if we started the week, we knew at the start of this week that today we will have this oil decision. That was one of the let's say the event that we will be facing. So now we need to be looking at the earnings season. Okay, so if you had any position, or if you want to build any position, you know that earnings season is starting next week, from next week. So here I'm using this Benzinga website that you can find here. You can have all the websites that you want. I like this one, but there are some others. So why you want to be doing so is you want to be looking at the earnings calendar. Okay, so that is starting next Tuesday, and it's always starting with the same names. And here I want to be looking at JP Morgan, because JP Morgan is the leading indicator, or let's say the leader in the banking, in banking, and it is one of the leader. It's giving you how the US economy is doing. Okay, but what we're going to be having is trying to identify at the start of the week what and when companies are going to come with their earnings. So if we take Tuesday, we get JP Morgan, we get Johnson & Johnson, we get Wells Fargo. And then if we look on Wednesday we get ASML, which is a European semiconductor, but they're going to tell you a lot about how the semiconductor is doing and might be doing in the next 2 to 3 months. Similarly, on Wednesday, we get the healthcare with UNH, which is United Health. We get Citi, we get Bank of America. Then on Thursday, we get the tobacco, which is defensive with Philip Morris. And as well, we get the miners with Vale. And then on Friday, we get the oil services with Schlumberger. Okay, so why you want to be doing that is you want to know each single day for the next 6 weeks who's coming on the tape and what they might tell us. Okay, so if we look here, I took the example of JP Morgan. Those have been the numbers from JP Morgan quarter after quarter. So if we look at the expectations and what they can be giving us, so that's the expectation, okay? And you need obviously to be comparing this expectation from quarter on quarter and year on year. But we need to take the assumption of later, as we will see, of two interesting things, which are the earnings and how they beat or not beat the expectations, and what is the guidance. So what I would love for you to be is to be ready for the earnings season. Okay, so again, the struggle is we have the numbers and we say, okay, this is it. They beat or they missed the numbers, and we're going to be trading on it. Now, what you want to be having, more importantly than ever, is you want to know when is the company talking to the market and coming with their conference call. Okay, so if we take the example of JP Morgan, so I went into on their website. I know that they are coming on Tuesday, okay, before the open, and actually, so they released here, and they're going to be doing this conference call. So for each company where your company is on the watch list, or you want to be having a position, you want to know and you need to know when is the company doing this earnings call. So if we take JP Morgan as an example, they will be talking before the open, okay? And Jamie Dimon, which has been sick, is probably going to be live. He's going to be talking, so he's going to tell you a lot about how the company is doing and how the US economy is doing. But you don't want to have a position that is where the company is coming, releasing the numbers before the open, and then during the day, during the trading hours, they are making their calls, and you're not aware of this. So those are the days where you literally need to be listening to the earnings call if you want to have a position, or if you're thinking about taking a position live. Okay, you can do it. You can go on their website. There are several websites that offers that in the US. So for some of you that are struggling with the fundamental analysis, this is extremely, extremely helpful, especially these days. And when you do the mentoring program with me, I strongly advise you to do it. Anyhow, you'll have to go through it. And the idea of the earnings season and the earnings call is done in two parts. So you get the first part, which is done by the management, where the management is more or less reading their transcript or their official release, where they say, okay, this has been the quarter. Then the second part is open to the floor, which is open to the questions of analysts. And this is the interesting part as well, because the big guys, let's say the Morgan Stanley, the JP Morgan, Bank of America, all those guys will be asking questions to the management. And they will try, and very quickly you can define what could be the turning points or the important questions to ask for this company. Okay, so try to put first in your calendar all the companies that you think are relevant for you in terms of sectors mover, industries mover, or do you want to have in your watch list. And then you need to know in the calendar if they are talking before the market, during market hours, or after market hours. Okay, so the struggle that we are going to have now is for the earnings season is, as I said, it's twofold. The first one is the earnings versus the expectation. So we discussed a bit the expectation last week, but you could expect probably the earnings to be down 20% to 30%. But as the US economy stopped at the start of March, we are, let's say, 2/3 of Q1 was fine. So only 1/3 was destroyed. So earnings versus expectation. I have a question here from Ivan. How would you react if QE earnings are a lot below expectations? The struggle here is how much is priced by the market and how much is not priced. So if we think back about earnings as the S&P 500, so this is something that I've done this morning during the mentoring with one of my mentees, is we take the earnings of the S&P for 2019, which stand at 158. If we think that 158, those earnings on the year could be down by 20%. Okay, so 20% minus 30, that gives you 120. At 120 versus the S&P, which is trading at 2750. Okay, so that gives you 25 times. Okay, so here you need to start to make a decision. How long is it going to take for those earnings to come back at least to this 158? So there was a paper this week from Credit Suisse saying it's going to take 2 years for this 158 to come back. So 158 earnings in 2022. So that means at this level of the market, you are paying 16.517 times earnings 2022. So coming back to you, even to your questions, you need at least to know what are the expectations, but you know by definition that the market is going to go all over up and down. But what you don't want to have is having the news, seeing a stock moving up and down and missing the move because you were not listening to the call. Okay, so I take the assumption that most of you don't have access to a Bloomberg or Reuters, so that means you can't see the news live. And if you can't have, or you don't pay for the services, at least you can log in on the company's website and listen. So again, there's going to be a lot of volatility because the struggle is on the earnings versus the expectation, because we have only done 1 month out of the 3 of Q1, which is in lockdown, and in terms of guidance. So in terms of guidance, companies are probably a visibility that is 1 to 3 months, and even most of them don't have. Okay, so this is the struggle. I think what is interesting when looking at the guidance is you have very often my mentees, and rightly so, will go for defensive stories. Okay, so when you go for defensive stories, you want to be looking for companies that have what we call a backlog. So they have visibility for X months. So if you take the example of Airbus, of Boeing, they will tell you that they have 10 years of backlog. So normally you should be safe. Who are the clients of Airbus and Boeing? They are the airlines. So from one day to another, or 1 week to another, all these airlines will be canceling all their orders. So suddenly the backlog that looked like 10 years is probably going to go to 1 year. And that's the same with other defensive businesses, where some companies will tell you, I have 3 months of backlog, but this is, let's say, a business which after those 3 months of backlog, they don't have anything else. So what you're going to be trying to find in those defensive names as potential shorts is the ones that have been doing very well, telling you I get a nice backlog, then suddenly the music stops because this is due to a business that has only 2 to 3 months backlog. I mean, easy to say, much harder to do, but earnings season is going to tell us a lot about the moves. We're going to be looking at sectors and industry, and again, highlight in your research the big names that are leading the sectors and the industry, because what you could be doing similarly to the drilling is if you have one name in a sector or an industry, let's say a big name in the sector that is moving up 5% on an intraday basis, you can be sure that the rest of the sector or the industry will be following. And here we are talking, because of this volatility that is insane, you can be making 10% in a couple of days, just by making ready and saying, okay, what are the names next Tuesday? That is the bank. So if JP Morgan is coming with good news, you know that the whole sector is going to go fine. If JP Morgan is saying, look guys, we're going to be really struggling, after having a very good day today, they're going to be down. Okay. So I wanted as well to be looking at realized volatility, implied volatility. So a couple of hours ago, I tweeted about the moves that we had today. So for some of you that have been trading, you know that implied volatility has been coming down quite a lot. Okay. So for today, I look at the SPY intraday move. We had a move that was 2.1% on the day. And that was a move that we have not been recording since something like, I think, 20th of February. Okay, on average, we had 5% plus move with a minimum of 2.7 and 9.2. So what we had is, coming into the earnings, many market participants reduced exposure. So on one hand, you get the Fed that is trying to dampen the volatility and trying to help the market and saying, look guys, we're everywhere. Don't worry, we're going to help you. And from the 23rd of March onwards, as market participants knew that the Fed was here, that was helpful, and that was a relief. And at the same time, because of the calendar, because of the earnings season coming, you're not going to come into the earnings season with a massive exposure. So you reduce exposure and you have a long weekend, which means that when you have long weekend, very often the volatility is dampening a bit. So here I want to be looking at different slides, which are always the same topic, which is about realized volatility versus implied volatility. So the first one here is the realized volatility, and it's S&P 500 1 month realized volatility. As you can see, it's still at 90%. Okay, so it's still extremely, extremely high. If you look at what we have normally is 10-15%. The next slide is done the implied volatility, the 1 month implied volatility, which is the VIX. So the VIX went into the 80s and now it's back into the 40s. But that tells you one thing, which is the next slide. There has been here a big, let's say, how do you say that in plain English instead of plain French, is a spread between implied volatility and realized volatility. So realized volatility is still very high. Okay, it's coming down as we saw today with only 2%, but implied volatility has been trending much, much lower. Historically, implied volatility is higher than realized volatility. Why? Because you want to pay more for, as a protection, you pay more in terms of implied volatility. Okay, so this is something that I cover in the 4x4 video series. But you can see here something has to give. That's a hard call because on one hand, you can argue that the market is moving way too much these days. Or on the other hand, you can argue that implied volatility is too low and there is a call for implied volatility to go low, to go higher. I think the realized volatility is too high and has to give because central banks have been helping. But that tells you that more or less since QE infinity, there has been a really widening because between implied volatility and realized volatility. And that's the next chart of a 1 month realized volatility versus implied volatility. You see here how negative that is. Whereas normally it's positive. As I said, because normally you pay more. The implied volatility is most 90% of the time higher than realized volatility because you pay protection. So as you are paying protection, you pay a premium. So this is the next slide, and we've done it before. This is the VIX and the future contracts of the VIX, and that's similar in a sense to what we've done with WTI. But that tells you what the market is pricing for future volatility. And again, similarly, you can argue that around June, July, everything is supposed to come down massively. So the market is pricing at the moment across asset classes a lot of volatility until June. Okay, similar to the person who asked me where to find this information. You go on investing.com, you go on the VIX, and they will gonna give you the future contracts. If you're good at macro, you're just taking the data and putting them on an Excel. If you're not, you're just doing copy and paste, but that's gonna give you the idea, okay? And that's gonna give you the structure of the VIX, the structure of oil, the structure of the euro dollar. You can do across many asset classes where you have futures, and that tells you. The idea here is the market will always be moving and will always be looking at new drivers. The drivers at the moment are volatility, credit, oil, okay, and some others. Every morning you wake up and you look at those. Maybe in 3 months' time, as we discussed, maybe the scale is going to move into emerging market. And every morning we will wake up and say, okay, where's Brazil, where's Turkey, where's Russia, blah, 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 okay. On top of that, if we think about emerging market that I recently discussed, is think about Russia. Okay, so Russia, emerging market, a lot of exposure into oil. When oil is at 20, it's not gonna help. Okay, so quickly before the Q&A session, the 4x4 video series. So we do have 35 plus videos, 40 videos. We do have 50 Excel spreadsheet. The whole idea is to build a strong watch list from macro, top down, bottom up, special situation, active trading. So this is here. And this is why I really want people to be making and generating ideas across different strategies and not being stuck with one strategy. I really want, through the 4x4 video series and through the sessions as well, to help you building your infrastructure. I think if you want to be successful, you need to be looking at infrastructure. So if you think about today, what we've done is we look at expected return versus realized return through the VIX, do a bit with Black-Scholes options, and something that is key, and I know for many of you this is a struggle, it's to move from qualitative into quantitative, from quantitative into qualitative and fundamental analysis. Okay, so there are roughly 5 videos or something where I help you looking at fundamental, because my background is not being an analyst, is not spending hours into fundamental. But if I don't understand what is the fundamental, both macro and on the standalone basis, I think it's really hard to hold the position and to sleep well. So that's something I explain. And I want you, again, from one session to another, from 1 week to another, when you're managing your own money, to be building a strong watch list. What is building a strong watch list? Is trying to generate ideas from different processes. Okay. And then at the end, we're going to have technical analysis, price action. So today we started with technical analysis and price action because, you know, the market is moving so much that we need to be looking at those drivers. And finally, the risk management. Again, for some of you who know me, you know that I'm a bit boring, but I'm boring in a sense that I want your risk management to be on top. Okay, so let's move now in maybe something more exciting for you, which is the Q&A. There is a question. So do you have any questions? From Toby. Do you have a view on whether the current equity market returns over the last couple of weeks, the bonds, will eventually be pulled down in line with what's going on to be some of the worst economic data we have seen in decades? So if you go through Twitter, you know that many people are short, and you know that the pain, you need to know where is the pain. As always, where is the pain? Is the pain long? Is the pain short? So in the sell-off, clearly very few people were hedged or let's say positioned for the sell-off. Okay, so the pain was on the sell-off. So the first move when we did 3,300 to 2,900, that was painful for many people. Some people reduced exposure, and then from 2,900 to 22, at 2,200, people were literally dying. So now there has been this bounce, and now I think the pain is on the way up, and you can see that the flow is drying, people are struggling, but the Fed has been helping big time. So there has been a dichotomy between the news that we have, which is, you know, NFP, that the economy is stopping, and on the other hand, asset classes that have been doing very well. And it is why I try to force you to be looking at the other asset classes which are really leading this sell-off and leading the bonds, which is the credit market. So the credit market is almost back to where it was before, okay? Because the Fed, because the ECB, because the Bank of England, the Bank of Japan, all the central banks have been putting a lot of money into the system. Again, I think this is their jobs to do it. So I'm fine with it. But the amount that they had to put to make the system work, you know, if you put 2.3 trillion today, that's roughly 10% of the GDP. So they're already down 10% of the GDP. So overall, the Fed is going to do 30 to 50% of the US GDP. That is just massive. If you have deterioration in the economy, at one stage, someone has to take the losses, okay? The question is, will that work in a sense that the Fed is taking the losses, let's say 10, 15 cents on the dollar, and because we're going to have a recovery slowly but surely in the next 3 to 5 years, they're going to recover those losses? Or we think that it's not going to be only a recession, but a depression. If that's a depression, then this is a struggle because the assets could go much lower and someone has to take the pain. And the pain will be for the Fed and other central banks. So that means, you know, at the end of the day, what you don't want to have is the struggle for all of us is when we have a strong conviction, but we're not listening to what the market is telling us. So we need to be looking at the price action, the technical analysis, and having a clear risk management. Okay, and I think this is why we are all failing at one stage. When we put a trade, we say this is a conviction, and we put away the stop loss. Next question. How do you think the Fed actions today help the financial stocks? Why? Because if you look at I think that's the 500 billion. So they did a 5 billion scheme, which is more or less the companies could go and ask the banks for a loan. The banks will only take 5% on this loan on their books, and the rest will be for the Fed. Okay, so that means, in a sense, all the new business that they will take, they're going to be taking only 5% of the 100 as a possible loss, with very good conditions. So again, the Fed has been coming, and I've been saying to Bank of America, JP Morgan, everything. First, we put a bid at 80 cents, and then if there are losses, we're going to take the losses for you. So there is not much to lose for the bank. And if you look at the price action, the bank were very, very weak. So that helped massively. Plus, you have the earnings from JP Morgan, Bank of America, Tuesday and Wednesday. So that means many people have to cut the positions before the earnings. Hi, Greg, a bit off topic. Where can I learn macro? If you want to learn macro, you can you can do the 4x4 video series, and you're going to learn good macro. That's the best way to do it, I would say. Why some sectors like cinemas is going 4 times recently, but every single new source of government says that they will be opening last. Look, I mean, there are some sectors that were bombarded, industries that were bombarded, and short covering, in your face, whatever. Again, when you go long and short stocks that could be moving 20-25% every day, you have to take in the assumption that it could be in your face. Okay, so it's nice to look at the volatility, but to play volatility is a different game. Okay, and what we covered recently have been the names that were absolutely murdered. So you're better off in the market like this, you know, having the names where you're ready to make the moves, where you know where your entry price, where your exit price, and when I say entry and exit, you know, that's stop loss, okay, and target. And then you trade them. Otherwise, you just reading yesterday's newspaper, and you know that there was like X death in wherever, which is absolutely horrible, and you think, okay, this is the end of the world, I'm going to sell everything. But in the meantime, many things happen, like the Fed. Okay, what's next? How do you see major farmers as a safer bet right now? I mean, yes, the farmers have been doing very, very well. They have been doing better than the overall market because this is their jobs. If you want to be, but what is the next risk? If you think about so short term, yes, this is good. But if you're talking US major farmers, imagine that you have Mr. Biden or a Democrat that is winning the elections. And suddenly they said, look, we need, because after what happened, we need all the prices of those prescriptions to go down 30-50%. The farmer is going to get destroyed. So you always need to think, okay, what's my short-term catalyst, which is, you know, risk on, risk off, and then what's my next catalyst in 3 to 6 months. Okay, I think the world, in some part of the world, could be changing. Maybe we're going to have a different ways of dealing with the pharma companies, because we're going to say, look, guys, you know, at the end of the day, you're part of the economy. Why should we be paying so much for those products? And here I'm not taking a stance. I'm not saying it's so expensive or not expensive, but you need to be thinking of what could happen next. Bit of a silly questions, but how many hours in a day roughly do you spend researching and looking into trade ideas, whether that is on one idea or multiple, or do you ever go steer crazy from it? Look, the thing is, and that's something that I very often discuss with other traders or portfolio managers, is when you do this job, you're hooked. Okay, so actually you read everything from 6 to 11 every day, and it's so everything is part of your process. Okay, and one of the struggles that we all have is to make a good filtering of all those IDs and all those data. So I'm always thinking market. I'm always thinking what could be the next position, and not because I love it, because, you know, as long as I find interest, as long, you know, these seminars, webinars are a very good example. You know, when I started, I was like, maybe what's the point of doing it? And then, you know, I started doing it, and actually my P&L, instead of trading like every day, I traded like once, twice every week, but my results were much, much better. So for me, it's a great incentive to do it. Plus I'm sharing ideas with you. But that means, you know, I'm literally the whole day looking at the market, looking at ideas, talking with some smart people. And the thing is, what you need to have is talking to smart people, because it's, in this world, there is a lot of noise. If you follow guys on Twitter, you know, it's completely pointless. But on Twitter, there are some good names, okay? There are some right people that can help you. If you can find it, that's gonna improve your knowledge. So to come back to your first question, because I always take time, I'm like an Italian talking, you know, researching and spending. I do a lot of research. Today, I've done the VIX. I spend, you know, on the SPY. If I got a new idea, I'll be looking. What did I look to today? Can't remember. It was a new company. I always look at new things. And the thing is, I don't want to be, when I look at something, I know that it's not going to be necessarily a trade. Okay. And I think the struggle for retail traders when they start is they search, they spend 3 hours, and because they spend 3 hours, they want to put a position. Whereas me, because I do have probably more experience, and I know painful it could be when you force the trade, I try as much as possible not to be putting the position. But I'm like anyone, you know, when the market is moving from 2,400 to 2,800, and I'm like, I missed everything, I was completely wrong, I was bearish, I need to do something, then this is the moment when you can be forcing the trade, okay? So what do I think about silver, especially with gold, silver almost at all-time highs? That's a good question. So the first thing that, so gold and silver, this is something that I already discussed. I trade gold and silver once every 18 months. So gold, I traded in January 2019, I think, and silver maybe a bit before. So I think that tells you one thing, that really the safe haven is gold more than silver. So everyone was telling us, not everyone, but, you know, if gold is going up, silver is doing fine. Actually, silver is doing shite. So in terms of I know what you're trying to play here, maybe, which is, you know, a reversion to the mean. Reversion to the mean is still possible. I think what happened as well is over the last 6 weeks, there has been dislocation. Okay, so suddenly something that worked well completely imploded. And gold, I'm not a big fan, but I can understand that, you know, some people have some gold in their houses, you know, under their bed. Having silver under your bed, I don't know. It's just before the call, I had this conversation with one of my ex-colleagues, and this guy is a phenomenal trader. I mean, he's living on a different planet. Very, very, very smart. And because of QE, as we all know, because of central banks putting money, he said to me, I mean, we should be long gold and cryptocurrencies. And I replied to him and I said, you know, it feels exactly like, you know, all those doom and gloom emails that you're receiving these days when telling you this is the end of the world. So me, I kind of feel each time I'm putting money in Bitcoin, I never did, but when I buy gold, it feels like, you know, this is the end of the world. And if that's the end of the world, what I'm going to do with my gold? What are you going to do with your gold? Okay, so that's always my struggle. But that doesn't mean that there is not a trade. And the thing is, I'm not, when one of my mentees came to me, that was 3 weeks ago, and said, Greg, I think 1460, 1480, there is a good buy on gold. He was right. And then I said to him, well done. I'm not telling you you should not be doing it. I'm just telling you that there are some parts of my strategies that works, and I'm not going to force my trade because I read someone doing it for me. Okay, so I'm not going to name some of the let's say programs on Twitter or that are making some broadcasting. Okay, you probably know the names, the doom and gloom going for Bitcoin and gold. There is a market, there is a niche, but I'm not interested. The thing is, I think you can generate shitloads of idea with the stocks, okay? But I'm not going to blame you to be making money in gold, okay? Because it's very liquid. You have futures. You can. So if you can do it, do it. I'm just telling you this is not where I'm good at, okay? There is going to be very little revenue from Q1. It's true. At least from Q2 more, and almost no from Q2. Yes, the markets are going up like crazy. Yes, Fed and others use bazookas, but do you really think that this is priced in the market or not yet? And we are waiting for massive sell-off again. Again, that's the same question that I had before. The market is always, so when you start making research about markets, people will always tell you, you know, you need to be looking 3 to 6 months in advance. So you're buying the market, forecasting the market in 3 to 6 months. That is very true. So if you are buying the market in 3 to 6 months, you can argue that in the next 3 to 6 months, hopefully, some of the coronavirus is going to be not solved, but it's going to be better. Okay. Still, in between, you have the end of the world. And when I say end of the world, the economies are stopping. And then you can't recover like this from these things. So here there is an imbalance between what we have every day. We are on lockdown. Probably most of you that are listening today across the world are on lockdown, or if they are not, you know, at one stage they were or they will be. And we know that Q2 is going to be horrendous. I think the beauty of the US is, and I say that as a European, you know, when the Americans are facing something, they go all in. Okay, so we know that from top to the bottom, everyone is going to go for a fight against it. So because they think about business, because they think how to reopen the economy as quickly as possible. So here we get some hope. But in the meantime, I think this is something that I discussed before. We came into this coronavirus crisis with weakening economies and economies that were already standing with a lot of debt. So the situation is worse. And if we look over the last 30 years, there has not been many times where we managed to create or to reduce the debt. Okay, and here again, I don't want to be in a doom and gloom / gold / there is too much debt and we can't do much. This is reality. But in terms of pricing, if you look at the call that I made at the start of this year, I said, you know, at 19 times earnings, this is extended. It can go even more, it can go higher. The thing is how to price these things. That means you can't go all in long or short. You need to have good risk management. Eduardo, yes. Look, on those people that are making those calls, they are very smart and they are making some good calls. They are very smart people coming into those interviews, and I'm fine with it. I don't subscribe to those products, but you know, those are good entry products. but you need to read between the lines, read between the lines that it's always Bitcoin's gold, the end of the world, blah, blah, blah. Yes, it works, but you need to do more than this, okay? When generating ideas within sectors, what simple factors do you do for filtering the best stocks picks and not getting overwhelmed by all the different companies listed? I think this is another issue that many people are facing. Is if you think about these 11 sectors and 75 plus industries, they all have different drivers. Okay, and the struggle is for me it's nice because I know that people will come to me for the mentoring because I'm going to help massively. Otherwise, it's a lot of experience. Okay, so if next week you'll be listening to 5 different earnings calls from 5 different companies, from 5 different sectors or industries, you will learn for 5 different industries. And I started to do that 20 years ago. 20 years ago, during my first earnings calls, I was like, what's the point of doing it? And then you understand when you listen to the earnings call, when you start to understand things, what are the drivers, and you see the stock moving, and you understand the quality of the management, then you do it. But there is no magic formula. There is no, maybe you can write actually, all the metrics for each sectors, you can do it. But still it's gonna be changing from time to time. Yes, you heard that there are a few banks that are on lending. I'll have to recheck that. I think in the US, we need to take the assumption that this is like any part of the world. It takes time for these things to kick in, okay? Especially for the US, I mean, it's a big country, it's a work between the Fed and the treasuries. I think Trump administration can be blamed for being late and think it was just the flu, but I think now they will probably try as much as possible to make the pipes work because they have the elections coming. So everyone and what Powell said today is actually they are working well hand in hand with the treasuries. So that works well. Maybe last one, and then we get a long weekend, Easter and Easter Bunny. Can I ask you, please, about your opinion about Corona bonds in context of EU debt bundle? So you're German, I'm French. So I'm socialist by definition. I think this is the time to share the pain. And when I say share the pain, if you believe in the European project, this is the moment to show it, okay? If you don't, people that were already struggling with, more than the majority probably struggling with the European project will come back and say, look, when we were in deep shit, nobody was there, okay? So, and on the other hand, you can argue that, and that's a very fair point, that the Dutch, some other part of Europe, which have been using low taxes, it's probably time to pay back, okay? By definition, if you think about the politicians that are pushing for Europe, they are using this opportunity to quicken the process. And I understand that people are struggling because, if you think that Europe is as strong weakness, should we carry on just in a time like this? I mean, everything is on the. I think we should really think about these things because we are in a time where we need to help each other. I have mentees in Italy, I have mentees in Spain, and I try as much as possible to get news from them. And it's not just bullshit. And because I think it's important these days to. And I'm not saying doom and gloom and this is the end of the world. It's just that otherwise you go in a funny country where you pay low taxes and you say fuck off to everyone and I don't care. But if you do so, stay on your island and don't bother anyone because you're not done to you should not live in this world. And to me, this is the way I see things. I think this is probably the time where we should do something, but you can see the internal struggles between people in Europe. Okay. Any other question? No? Okay. So thank you, everyone. Have a good long weekend. If you have questions, again, send me an email to contact@Gregoire Dupont, both on the 4x4 and the mentoring or some other questions. Thank you for joining. This is really a pleasure to build ideas and sharing ideas with you over those sessions. Have a good long weekend and be safe. Bye-bye.